Right. Well, thank you for joining us. We'll go ahead and get started, and hopefully a few more folks will join in. But we'll have a good conversation with the group that we have. Thanks for joining Coastal Housing Partnership for our webinar series. Today's topic is navigating the process of obtaining a home loan. We'll be giving lots of good information, covering lots of common questions and topics that will help you kind of think through or prepare or start the process, as it says, for getting a home loan. That being said, if you have questions, please bring them to us. This is meant to be an interactive webinar. We would like to use the question and answer section. If you have trouble with that, you can put your question in the chat, but we will use the question and answer section. This is a webinar, so you won't see yourself or be able to speak, but please do feel free to put up those questions that you have throughout the webinar. With that, I'm very excited to introduce our presenter today, Linda Hall with Nexa Mortgage Company. She is also a member of our board of directors, so we are pleased to have her join us today to present and to give us some great info and insights into the process of getting a home loan. So welcome, Linda. Thanks for joining us.
Thank you. Thanks for having me, John.
So we'll get started here, and Linda and I will kind of have a conversation that will help you understand the process. We will be sending out this recording, but as I said, questions are welcome. So Linda, just to get started, if I am interested in buying a home, what is a good time to start meeting with a lender? And when in terms of looking at homes or meeting with a lender, or when is the best time to start that process with the lender?
Right. So I would say anybody who is on this call right now, you're showing interest in it, and now would be the time that you would want to be doing that. Certainly, once you do connect with a realtor, they're definitely going to want you to have been in touch with a lender, and if not, they will refer you possibly to a lender. So I would say if you're thinking about buying a home is when you start looking and finding a lender that can help you.
Good. And so what would I be doing with a lender now if I'm maybe just thinking about buying, or I don't know if I'm ready?
Right.
What are the important steps going to be?
Right. So the important steps are obviously getting in touch with a lender. And then what we do is we do a pre-approval for you. Okay. So we want to go ahead and have a conversation. We want to be able to find out what your needs are, what you're looking for, as far as what type of property maybe you want to be looking at, the area that you want to be looking at, and then start what we call a pre-approval process.
And tell me a little bit about that. What does that take? And maybe, there's a lot of talk about credit score. Is that
Right.
part of that process? And what do we need to be concerned about? Or if my credit score is low, should I wait to talk to a lender?
Right. So first of all, there's two different kinds that you'll hear about as far as a pre-approval or a pre-qualification, and there is a difference between those. Okay, a pre-qualification is basically someone who has taken an application and just run some preliminary numbers. Okay, and that's called like a pre-qualification. They would have had conversation with you, maybe asked you what you thought your credit score was, and like I said, put together some numbers for you. A pre-approval, it goes in much deeper. Okay, so that's the point where you would make an application. We would look at your credit and see what your credit score is, see what your debt obligations are, and then be able to do an act as well as your income. We're going to look at your income as well. We have debt to income ratios that we look at when we are qualifying someone. So what the debt to income ratio looks like is we take what your housing payment would be, what your mortgage would be, as well as your monthly debt obligations. Most all of that is going to show on a credit report. So we take into consideration if you have any car payments, if you have installment loans. We don't take into consideration like car insurance, those kinds of things. Mostly everything that's going to be reporting on your credit report. Unless you have something like child support or something outside of that that doesn't report, we're going to be asking you those kinds of questions. Okay. And then we would develop an approval and determine how much you would qualify for and what type of program might fit you best, which we'll get into a little bit later in the conversation. As far as credit scores go, for those of you who are not aware of it, a lot of people don't understand that it's called a FICO scoring system, which is what all the investors use in order to determine, one, if you're eligible for a loan, two, it will affect the pricing of the loan. Okay, so the higher the credit score, the better interest rates you're going to receive. Okay, the lower the credit score, you're going to typically have a higher interest rate or maybe more cost to obtain that rate. I'll get into that a little bit more detail when we go into the types of mortgages, because there are ones that do allow a lower credit score in which your interest rate is not affected by that.
Great. So, just a couple to dig a little deeper on the credit. When we talk about debt, are there things that, sometimes people have larger medical debt, or maybe they almost paid off their car, and the underlying question too is, if I've got these things that maybe are questions for me, should I fix all that before I talk to a lender and
Right.
pay it all down?
So many people think that they should dig into their credit and try to clean it up themselves or make it look the best that they can, thinking that they should have as least debt as possible, which in some respects that's fine. But there's also, through the qualification piece, for instance, if you have a car payment and you have less than 10 months remaining, we don't have to use that car payment in your debt to income ratios that we use to qualify you. So, I've had people many times say, well, I want to pay off my car first. I want to do this. I want to do that. I said, no, hold on. You don't have to do that yet. And so, we're going to put together a plan that's going to obviously benefit you and your scenario the best.
Great. I just want to remind, we have a few more people who've joined. If you have questions, feel free to put those in the question and answer section. I don't see any. If you have tried to put one in and it doesn't seem to be working, you can put it in the chat as well. But feel free to send us your questions and we'll incorporate those or get to them at the end. So I imagine that we do have a number of potential first-time home buyers on this call. Maybe not all, but let's talk about some of those loans or some other programs that may be appropriate, or maybe are there first-time home buyer programs, and what kind of programs might there be available for them?
Right, real quick, John, I want to just touch one more thing in regards to credit, because you did mention medical
Oh,
bills.
yeah.
Which medical bills should not be reporting anymore on your credit. At least if they're reporting, it's not affecting your credit score.
Great.
So that's like a really important thing. That was a big change for us in the lending industry that has really helped a lot of people, right? Because before we had to use that in their debt to income ratios, we had to use that as a debt obligation. Or there could have been like late payments on it, and which a lot of times in the medical, excuse me, billing systems, you can be sent to collection and not even know it.
Yeah.
So those kinds of things, those are things that have been mitigated to where those aren't taken into consideration anymore.
That was a pretty recent change?
It's a recent change. It's a big plus.
Yeah.
Big plus.
Yeah. That's great.
And
Good.
then also, if you're looking at your own credit, like, you can pull your own credit, you can see something on there. I just want to make people aware that if you're trying to fix something on your credit, it's even more important to talk to a lender because we can help guide you with that rather than going to a third party. There's a lot of scams out there who saying that they're going to, you pay them so much money, they're going to fix your credit, and they might send you a credit report that looks like it's fixed, but it really isn't, or it might just be for a period of time. So those kinds of things are definitely something to be watching out for, and that's something that a loan officer can guide you with of
Mhm.
if you needed to have some assistance with that.
Yeah, yeah. Um, one other thing I know that people have come across, is the different types of credit reports, meaning, if I just bought a car and my credit score
Mhm.
was, should I assume that's gonna be for the same for a house or a credit card,
Right,
something like that?
right. So that's definitely a misconception. So there's, I think at last there was like 250 different algorithms for credit scoring. Okay.
Mhm.
So when you are going to buy a car, they look at it, it's a completely different algorithm that they look at. And how much information is actually pulled through. When in the mortgage lending world, obviously we're lending you a lot of money. So we're going to dig in deeper, and that score is most likely going to look different. And typically it's going to look lower than what you might see even online or something like that. Not necessarily, but it can happen.
Yeah, okay, great. Well, lots of things to consider. So going back to the question of, what about if I'm a first-time home buyer? It's a
Mhm.
lot of things. Are there other things that I should consider or that are going to be unique that might give me, a benefit or advantage of being a first-time home buyer?
Right. So first of all, a first-time home buyer, the definition of a first-time home buyer is someone who has not owned a home in the last 3 years. Okay. And it's actually a primary residence. So if you've owned a rental property and you haven't lived in that property in the last 3 years, you're considered a first-time home buyer, okay, as your primary residence. That's the definition of a first-time home buyer. There's many first-time home buyer programs out there that can help you. There's government-backed programs as well as community programs, and there's grant programs that are available. So there's a large array of programs that are available to first-time home buyers. And there's many that you don't have to be a first-time home buyer and you can still take advantage of those low down payment programs.
And if me and my partner, or if I make good income, our first time home buyer option is going to be available, or are those income restricted?
Right. So there's some programs that are income restricted. There's some that are census tract restricted. So that means the area in which you're buying. And many of them, the first time home buyer programs, for instance, like FHA, they have no income restriction. And there's a particular grant program out there right now that we actually offer. It's a FHA program. It's 3.5% down payment, but you're given that as a grant. Okay,
Mm,
so you do not have to pay that back. You also do not have to be a first-time home buyer.
wow.
So there's like there's an array of many, many programs out there. There's community ones that are specific to communities, city programs. So again, that's why it's super important in especially at this juncture when you are just starting to look at purchasing a home that you get with somebody that is knowledgeable in that and can help direct you with those different programs that are available to you.
Yeah, yeah, it's a big thing. So let's dig a little more into that. Like, the other thought, aside from a first time home buyer or not, I, people here, we need 20% down. You mentioned an FHA grant that was much lower than that. So should we expect to have to save 20% before we are ready to start looking at homes?
No, no, the majority of home buyers do not have 20% down payment, especially here in California.
Hmm.
So there's conventional financing, which is outside of FHA or the FHA or VA, which are government programs, um, based on bond programs. Conventional financing, so that is your conventional, which is through investors who are called Fannie Mae and Freddie Mac. They have as low as 3% down payment programs that are available. FHA has 3.5% down payment. VA is 100%. So if you're a veteran, you can actually take advantage of your eligibility and be able to purchase with 100% financing. Those interest rates for FHA and VA are typically lower than your conventional financing rates.
Great. Those are, yeah, I know the VA loans are fantastic, and we hope that any veterans on this call will consider and make sure they look into that.
Yes.
It's a great program and well deserved. Just a reminder, if you have questions that come up, please feel free to drop those in the question and answer or chat section, and we'll try to get to those. We want to make sure this is we're answering the questions that you have.
We love questions.
We do. Okay, so let's talk a little more about the down payment. So maybe I don't need 20%, but what if I'm talking to my family or somebody's passed away and I'm getting, or if I have all my savings is in my 401k,
Right,
what are some options for that down payment?
right. So programs, all the programs allow gift funds. Okay, so you can have gift funds. It does need to be from a relative. The requirement for that is there is a gift letter that is filled out by the donor as well as yourself. And those funds can be given to down payment. It can help with closing costs, any of that. So gift funds are available. If you have an inheritance or something like that, that's perfectly fine as well. John, you mentioned a retirement account, which many people are accessing to obtain down payment and closing costs, or a portion of.
Hmm.
So there's different ways. So it depends on what your 401k or what type of IRA you have, that whatever their restrictions are. But many of them, if you're purchasing a home, you can withdraw without penalty. And then many as well, you can borrow against. So basically, you're borrowing against your own funds. There is a payment that you make to that, which is just taken out of your paycheck. We do not use that in our debt to income ratio, because if you think about it, you're actually borrowing your own money and paying yourself back. So we don't use that. So that's a great avenue for people to consider, as far as being able to access funds to help or for your down payment and closing costs. You can also borrow against a fixed asset. So let's say you have a free and clear car, you could refinance and take money out of that for a down payment. They allow for that. Okay, that's actually the only avenue they allow for borrowing funds. That, and obviously the retirement account. In that scenario, we would use whatever payment that is in calculating your debt to income ratios for qualifying. The one piece is cash is not okay. Okay. So it's also known as mattress money. That is not allowed. Okay. How that is determined is funds need to be deposited into a bank account right, for us to be able to verify that you have the funds appropriate to close the loan. We use 2 months of bank statements, so it has to cycle through 2 months. So let's say you did have some cash, and a lot of people are keeping cash, so this isn't out of the realm. Is you want to get that deposited into a bank account and have 2 months of bank statements so it cycles through to where it's not an issue. Because we will ask for, if there's large deposits, we will ask for those to be sourced. Okay, and so they have to be able to be sourced from maybe a transfer from a savings to a checking or another account they might have outside of that account. So those things are all things that we have, that we consider for financing, approval financing.
Mhm. So if I'm understanding that right, if I have cash, and I'm ready to put an offer on a house and I put it in the bank, um, just telling you that that was my cash I put in the bank yesterday is not sufficient?
It's not sufficient. It would actually be backed out of whatever balance you have, and we would not be able to use that as funds to close or for down payment. That's a really good question.
And one of the other places I've heard of retirement accounts being used, and this can be a little surprising to people, I think, is I've got my down payment, whatever amount it is, and for my program, I know, at least I have heard, it's been the case, and maybe this is still the case, that lenders need a reserve, or some funds for a reserve account of some sort. Or
Right. So some programs require that. It kind of goes hand in hand of the larger down payment. You might not have to have reserves. It could be the actual credit package itself that we're working with, that they might want to see 2 months reserves. That's pretty typical, the 2 months reserves, if it's required. But we also use automated underwriting systems. Okay, those systems allow us to input your information that we've verified,
Hmm.
and it comes back telling us if you have to have reserves or not. Usually, like with FHA, most of those programs, you don't have to have reserves. It just really depends. It is going to look at the whole picture. It's going to look at your credit score. It's going to look at, a variety of different things.
So there's a lot of options. It sounds like there's a lot of pieces to this, and it's a process, and you need to have somebody that you're talking with a lot, and exchanging really important and sensitive information. So,
Right.
um, how do I find that right person? How do I select the lender or find the right lender to start this, pretty in-depth process with?
Well, a real good place to go is Coastal Housing Partnership. On your website, you have lenders there that are a part of that. That's a good place to start. Also, obviously, referral from family and friends. They've already had an experience. And then if you are working with a realtor, they oftentimes have people that they work with that they know and trust. And that's really, really super important, because the process can be daunting,
Mm.
okay, especially for first-time home buyers. Even people who have purchased before, it's a bit of a different environment. And so that piece is really important. It's important that you can communicate directly with your lender to clarify any concerns. As you're going through the process, I always encourage clients to, if you're thinking about something and you have a question, call. I can probably answer it, and a good loan officer would be able to answer that in a matter of minutes, and really relieve you of a possible headache or,
Mhm.
or feeling stressed about something. So that's really important, the communication, and then trusting your instincts as well, because remember, I think you need to feel like you're interviewing that person, right? Because it's a very, very important step in your life. And you want that person to be there for you to be able to not only educate you about the process, but also be there with you as you're going through the process.
Good. Yeah. Yeah, it's really a partnership and relationship with the lender and with the realtor and all of you working together.
Yeah, so it's paying attention to how responsive even your realtor is, how responsive they are to you.
Mhm.
Because once you go into a contract, there are contingency dates that you have to meet within that contract. And so it's really important that you have a service level. You feel like you have that person that's going to service you and meet those dates for you, because it really is in our court to make sure we meet those dates for you.
Mhm.
So from a borrower's standpoint too, in that respect, it's important for you to be providing all of the documentation and all the things that are needed in a timely manner, because then we can work together to make sure, we meet those contingency dates within your contract.
And let me just remind people at this point, as Linda mentioned, we have a list on Coastal Housing Partnership of all of our network partners. And these are lenders, loan officers that are partners with Coastal Housing Partnership. And because of your employment with a member employer, they are offering discounts to you on those closing costs. And a good lender is there are no upfront costs. You're going to be paying all of your costs at closing, which is where the discounts from the partnership will take effect. So it's definitely a good place to start. If you have a friend or a referral, see if they're on that list. If they're not, feel free to have them or you call us or email us at Coastal Housing Partnership, and we can chat with them, and some of them are amenable to honoring the discount through the program. So make sure you do check that out, as well as for your realtors, inspectors, and that other team members for your process of buying. What are some of the big factors I should look for in addition to communication and responsiveness that you've mentioned? Obviously, people are concerned about interest rates. Is that a starting point? And if I'm Googling interest rates and I find something online, should I just go with the best interest rate, or what do you recommend about that?
Yeah, as far as online, it's a good place to get just kind of an idea of what rates are doing. But most everything online is discounted. Um, they're discounted lenders, in which you are not going to have the line of communication that you really do need to have. Um, the I If you're refinancing or you're in a place like that, I think online, would be okay. You don't have contingencies that you have to meet, and that type of a thing. But initially, keeping in mind that we all get our rates and all of our money from the same pot. We're not getting it from different places. So as rates are important, I think when you're online, all you're looking at is one rate. You're not looking at all of the other factors that come into play determining what your rate is. Okay, so we're talking like down payment, also known as loan to value, credit score, the whole type of loan. So you're not getting a clear picture of rates. But like I said, the mortgage bankers, the banks, we get our money from the same place. So they should be competitive. And there is nothing wrong with shopping. I think that that's a very good thing to do, because they can vary, but they're not going to vary that much.
And what about or I'll phrase it differently. I mean, I know that we live in a very unique area, Ventura, Santa Barbara, San Luis Obispo County, where um, those of us who've lived here for a long time, we know about the fires and other things. So it's a unique area. So is it worth looking at local lenders versus somebody somewhere else in California? Does that matter too much, or what do you think?
Local means is very important. Um, and when I say that, I mean that because if you don't know the area, even loan quotes that you'll be receiving are not going to be indicative of the area. Um, there's, we have insurance. Okay, insurance is different in this area than other areas in which, and I'm talking about homeowners insurance, which is a big issue right now. Okay, because of the fires. Um, there, fortunately, we're fortunate in California that we do have uh, a bond supported insurance avenue for areas that are prone more to fire, what they consider in the fire zones, or even flood. Um, so we're fortunate about that. But to know, just from area to area, even closing costs can be different. So it's really important to have, as close to possible in that area to determine what the actual costs are for that area.
Great. Um, again, just feel free to throw up any questions that you have. We'll keep trying to cover topics that you might have questions about. So let's talk a little bit about the current situation and where we're at. I mean, rates have changed in the last couple of years a lot.
Right.
We have some other larger global and national changes that are going on. So tell me a little bit of your perspective on the current lending market and how it's changed, and maybe a little bit of your crystal ball where we're headed.
Oh, a crystal ball. That would be so nice. Um, yeah, I mean things are pretty volatile right now. And interest rates change every day. So I don't know how many of you are aware of that, but we don't have the same rate and the same cost every day. In fact, they can change throughout the day. So that's another important thing is that whoever you're working with, you want to make sure that they are watching the market for you. Okay, because a rate can change from the morning to the afternoon. And there's a time where you lock in your loan. Okay, so you're locking in your interest rate. So you want to make sure that you have somebody who is in tune with the market as well for you. Um, we've obviously been experiencing higher interest rates, but if you really think of it over a longer period of time, the lower interest rates that we were enjoying for probably way too long um, is not indicative of a healthy market. Okay, we really in a healthy market, our rate should be in the sixes, which we are right now. Some are up in the sevens. It just depends on what kind of program you're on or whatever. But as the one thing that we have been able to help mitigate the higher interest rate environment is we offer what's called temporary buy downs.
Hmm.
So you can do that for 1, 2, or 3 years. And how that works is you still have a fixed mortgage rate. So let's just say your mortgage rate is 7%. Okay. We can do what's called a buy down, where funds are put into a buy down account. And for that first year, if you're doing a 1 year buy down, that first year, it allows you to pay your interest and payment at 6%. Okay. So it gives you that little bit of flexibility for the first year in your home, getting used to the payment, also being able to maybe use some excess funds to do some things with the property. Obviously, when you're moving into a new home, there's going to be things that you want to have, like maybe a washer or dryer or something.
Mhm, mhm.
But so there's different things that we can do to help mitigate that. You can also pay what they call points to buy the interest rate down permanently. Okay, so you can pay points to buy the interest rate down. A point equates to, let's say you're paying 1 point, which is pretty common right now, just to pay a point for a market rate. Let's say you have the ability to pay 1.5 points or 2 points. What that's based on is if it's 1 point, it's 1% of the loan amount. Okay. And that's the cost to obtain that lower rate. Does that help a little bit, John, with
Yeah.
that?
Mhm. Yeah, no, that's great. Yeah, I think it's really important to know that the markets are always changing and, like you said, why it's important to have somebody who's communicating with you well, and kind of helping you identify the date to lock that in. Um,
I mean, to speak a little bit too about the rate environment. The past 2 years we were given these teasers that, oh, the rates are going to come down in September. Oh, they're going to come down into, well, that didn't happen.
yeah.
We have seen them come down a bit. But I don't see that happening probably for a year or so. So I think it's important to think about the fact that while you might be paying a 7% rate or a 6.75% rate, whatever the case may be for your particular situation, that it's temporary.
Mm.
Because when rates do come down, you have the opportunity to be able to refinance that. And
So should I wait until rates come down if I'm
no,
ready to buy and I have money?
what happens with when rates come down, there's that much more people pining for that property that you want. Okay, so you're going to see many more multiple offers on properties as soon as rates come down. So it does not make sense. If you are ready and you're prepared, pull the trigger, because you'll be in the property, be able to refinance at that market rate and not have the competition that you will when that does happen.
Great. Good. I have, let's see. Well, I'll give you a chance to answer this because we had it on our list of questions. So, and then I'll ask you my other question if I don't get other questions from the folks listening. But so, what other piece of advice would you give to someone looking at a home loan? What's your golden nugget that you would give to a potential buyer?
In looking for a home loan,
Yeah. Yeah, what piece of advice haven't we covered or you think is important for somebody looking for a home loan to know?
well, I would say that I think I pretty much covered it. You really have to trust the person that you're working with, John.
Yeah.
It's so important. Because and that person being there for you. Because
Hmm.
there are things that can go wrong and there are things that can go a little sideways. And in my experience, most of those things get taken care of without the borrower even knowing about it, right? You want to mitigate all of that in the background. But there are times when we do have to have the borrower involved, and you just want to make sure that you have that person that you know and trust, you know, as much as you can. But it's really instinctive, I believe.
Yeah.
Um, and keeping in mind that rate is not everything. So someone might be offering you a rate, but are they going to be able to perform? Are they
Mhm.
going to be able to be there for all of those things and not have something, um, for instance, when your loan gets to underwriting and they come up with something that you now don't qualify for? You really want to make sure when you're going in and making that offer that you have a solid approval.
Mhm.
So I
Yeah.
would say that's probably the biggest nugget is to make sure that you do have a solid approval when you go to make that step to make an offer.
Yeah. Yeah. So it's so important, talk to a lender early and find somebody that you get along with well, because they are a really important part of your team, and they will be with you to the very last moments, and then hopefully beyond that, and in future transactions. Okay, I had another question going back to something we talked about. So uh, you talked about insurance and now the insurance costs and things. How does that impact my ability to get a loan? Why does the insurance amount matter?
Good question. So when you purchase a property, you'll be required to obtain your own hazard insurance homeowners policy.
Mhm.
So those policies, a lot of the larger companies like State Farm, Farmers, they aren't writing in California anymore. So and the rates have gone up. So we require, as a lender, will require you to pay upfront when you close your loan, a 1 year premium. Okay, those premiums have been increasing. So it's important for us to know that that's something when you're in the process, right? When you get into contract, and it's important to take that property address and go out and start shopping for insurance.
Mhm.
Okay, because you'll be able to see what kind of premiums you have. We use a 12th of that premium. Okay, so if it's a yearly, we use a 12th of that for qualification. Okay, so part of your mortgage payment is going to be your principal and interest that you pay to the bank or mortgage company.
Mhm.
And then you'll have your taxes, your property taxes, and then you also will have your hazard insurance. So that is a important part. And another reason why I had touched on it's important to be with more of a local person because they know what those are. So when we're estimating, because basically that's all we can do before we have a property, right? Is estimate how much that insurance is going to be. And
Mhm.
we're qualifying you and we might be pushing that debt to income ratio a little bit. That insurance can't change. So it's important for us to be using an appropriate prorated amount for that insurance when we're calculating your monthly payment.
Yeah, and I think that that's just a really important thing to know when you're looking at line online, or if I'm Googling. It's not just principal and interest, it's taxes and insurance also. You might hear folks talk about PITI, principal, interest, taxes, and insurance, and those all are part of your payment, and that's going to determine how much you can, how big of a loan you can afford. So
Right.
those are really important, and good to have a good lender who can calculate that for you and give you some good advice on the size loan that you have. Um, well, we're a little early yet, but so we definitely have time for questions. I'm hoping that our questions are working, but I'm not seeing any. So,
I see one here, John. It said,
okay.
would a lender be able to talk to you? Oh, would a lender be able to talk to you about which programs we qualify for, or do we do the research for ourselves? Okay, that's a great question. And yes, a good lender is going to be able to do that for you. Um, Certainly, and I can say I've had sometimes when a client has been searching on the internet and they're like, "Oh, here's this program." And I'll go ahead and research it and I'll go, you know what, that it's not a viable program or something like that. So yes, a lender would and should be able to guide you to a program that that's going to be best for your needs.
Great. Yeah, great question. I guess I'm not seeing them. Are there any other ones up there?
Well, it says, someone says, I see the Q&A, but the chat is disabled, so I cannot tell you. Let's see. Oh, what does going through coastal housing lender help us with? I think we touched on that a little bit.
Yeah, so a coastal housing partnership lender is a network partner is offering a discount on their fees. So you will see a discount. It varies from the different lenders, but they're typically a portion or their lending fee. So it's probably $500 to $700 or so for a lender. Also, you can work with a network partner realtor who's going to offer about 20% of their commission as a credit towards your closing costs. And maybe you can speak to what do the closing costs look like, Linda, and how would that credit, benefit us?
Yeah, so it's a great benefit. And we hadn't touched on that about credits that you can receive, because you can actually receive credits from a seller as well towards your closing costs. So that's another real important piece too, is to have a real good realtor who can be negotiating those things for you, because there's different ways that can happen. So whatever the sales price is, let's say there's some room in that, and you might be able to offer a little bit more for the property and have the seller credit you back a dollar amount to go towards your closing costs. And we see that happen. And as much as even, one good thing that we're seeing right now in our environment is, number one, we're seeing properties sit longer. Okay. And we're seeing more inventory, which has been a really difficult challenge for us in the last couple of years. So we are seeing more inventory, like I said, and not as many multiple offers.
Hmm.
So now it's actually kind of like a really nice little window right now that we're seeing in our environment.
Yeah. What should we expect for closing costs?
Yeah,
What type of numbers are we talking about?
the typical is 3%. You can typically take 3% of the sales price and consider that for your closing costs. Of course, that can vary if you're in a lower range, but we don't have very many lower ranges here in California. But yeah, so typically it's a 3%.
Yeah, and so that's not an insignificant amount of money that you have to come
No.
up with, and so some credits towards that are really important. And if you can save $3,000 to $5,000 from your coastal housing network partners, that can go a long way to offset some of the costs for those closing costs. So it's a great benefit that's available to you at no cost because of your employer. So to really try to take advantage of that and utilize that benefit that you have. Good. Any other questions that you see, Linda?
Can you borrow against a retirement account even after you retire? That would be, I am not sure. I think it would totally be up to that particular retirement account. I've never seen you be able to borrow off of it after you retire. I've only seen you be able to withdraw it. But if you're of that retirement age, remember you don't have a penalty.
Right.
So yeah, so if you, I think it's 59 now, 59, 60, if you withdraw from a retirement account, you don't have a penalty. But after you retire, that would totally depend on what type of an account you would have. You would have to go to the administrator. But I would say, generally speaking, I don't see borrowing funds after you retire, because they don't have like an employer. You're not employed with someone to be able to be secured knowing that that payment is going to be made from your earnings, right? So typically, if you have a loan against a 401k and you leave an employer, typically you have to pay that back.
Yeah, and once you retire, you're typically going to roll that 401k or 403b into an IRA, and
Correct.
the rules are slightly different. And again, like Linda was saying, once you're 59 and a half, and if you retire, you can take the money out. You know, that's what it's there for. Now you can utilize it for whatever you need to, but certainly for your down payment, and you wouldn't be required to pay that back. It's your money now. You could certainly add back, well, you can put it into other investments if you have money to pay it back. But that digresses into a bit outside of what the scope of what you or I are professionals in at this point. So,
exactly.
to talk to your wealth advisor and your, as you said, your plan administrator. But great questions, and thanks for your participation today. And thank you so much for your insights and expertise, Linda. We really appreciate your sharing.
Thank
If you have
Thank
other
you.
questions, feel free to email us. Contact the Coastal Housing Partnership, and I see I didn't put your email on here. I apologize. Do you want to give us your email, Linda?
Oh, sure. I'll type it in the chat.
Yeah. Drop that in the chat. So if you want to reach out to Linda with additional questions, please do that.
Oh, how come the chat's not working?
Sorry, guys. I don't know what's happening with our webinar here.
Oh, here we go. There it is.
Great. Well, thanks so much for everyone for attending. We hope you have a great day, and we will wrap it up here as we come to up to the hour. And thanks again, Linda. And
Thank you. Thanks for attending. Have a great day, everybody.